Chapter 3 was about how to calculate globe income. Chapter 4 was about how to calculate the cover taxes, the numerator. And the fifth chapter is about computation of ETR and top-up taxes. TUT is top-up taxes. Here, we looked at the numerator in detail, the denominator in detail. We will also look at the product in detail because there are few things that we should understand. There are 6 chapters in this one, and we will start with 5.1 ETR calculation mechanics. So this would kind of make you understand a lot of things which were not clear, or it will kind of bring everything, align everything so that we are in the same page. Okay, the first chapter is ETR calculation mechanics. Okay, so now you know the formula, right? So let's have some talk about this. So you know the formula. What is the formula? So ETR is equal to um, adjusted cover taxes divided by global invoice. Correct. Now, this is all fine. I mean, we have spent so much of time in understanding what this is and what this is, so it is fine. But what is very important is sorry, where would you use it? So let's get that very straight. Pillar 2 has the concept of what we call as jurisdictional blending. Okay. It's very important to understand the meaning of this term. Now, what is jurisdictional blending? Okay, what is the whole purpose of top up taxes? So the thing is, the idea is that everybody, you have to pay. If you're a large M&E group, you have to overall pay 15% corporate tax or 15% taxes. If you don't pay 15% taxes, then you have to pay top up taxes to the difference between what is your effective tax rate and what is the between 15% and what is your effective tax rate. Okay, now it does not work as one M&E as a whole. Say, let's take if I have one M&E. Okay, I have an M&E. So let's say this is in UK and this is in Netherlands. And let's say this is in China, or this is in UAE. And this is again in UAE. And this is in, let's say, UK. Okay, this is my group structure. So am I an M&E? So this person is holding 100% of this and this person is holding 100% of this, and this person is holding 100% of this. So you tell me, am I an M&E group? Am I an M&E group? Yes or no? I am an M&E group. Definitely, I am an M&E. So So if you are so bothered about to see whether I am paying 15% taxes, why can't I take the total of all the adjusted cover taxes of all the jurisdiction divided by the globe income of the jurisdiction using the consolidated financial statements? And why can't I see whether it is 15% or not? So why if I do that, if I take everything as a whole, then what will happen is, let's say UK has 25% taxes. Okay, Netherlands has 32% taxes. UAE has 9% taxes effective rate. This guy is a qualifying free zone. He is paying 0% taxes, and this guy is having let's say 45% taxes. So he is an oil or something. If I take everything as a whole, the problem is if you see UAE is not paying taxes of more than 9%. So it will completely escape from the radar if I take, because all these high tax jurisdictions would shield the low tax jurisdictions. And ultimately, if I take as an MNE group altogether, say if I take the MNE group altogether, then definitely I will be exceeding 15% tax. So, in order to avoid that, in order to avoid artificial structuring to be done, all this ETR calculation shall be done on the basis of jurisdiction. So, UK jurisdiction, they have two entities in UK. They have to compute top up taxes separately. Netherlands has to compute separately. There is only one entity, and UAE, even though it is held by different people, it's okay. But you have to calculate the 15% ETR, whether you satisfy it or not, separate. So this jurisdictional blending is a masterstroke. So in such a way, not just they could ensure not just that the globe as a whole pays 15%, but they could also ensure if the jurisdictional, if they are paying 15% in each jurisdiction. Okay. So if somebody asks you what is the core concept of or the ETR mechanics, is it on an MNE based or is it jurisdictional based or is it entity based? What is your answer? What is your answer? So how will you apply this ETR, whether it is MNE based, jurisdictional based or entity based? Answer is it is jurisdictional based. If it is MNE based, as I told you, the high tax jurisdictions could shield the low tax jurisdictions from paying any taxes. Okay, if you take an average out, definitely this would be more than 15%. If it is entity based, every entity has to file a GIR return and it gets a little complicated, right? There would be extra tax that would be, taken by the government, and it would be very harmful for the MNEs, or the whole concept of globalization will come at stall because I'm paying so much of taxes. Like, I can't kind of, and also sometimes what happens is, let's say this guy is given 0% because he is employing substance. He is putting a lot of money on investment, so government wants investment, and that for that he is kind of given some tax benefits. Now those plans of low income countries getting investments all will be kind of completely obliterated if there is an entity based ETR calculation, right? So what they are saying is we'll take a middle approach, which is jurisdictional based. So it is a mix of both. There won't be much compliance and taxes as entity based, but there won't be such a leeway as an MNE based. So it's a middle ground approach that you are taking. Are you getting what is meant by jurisdictional blending? So ETR should be calculated on the jurisdiction, not on an entity, not on the whole MNE. Okay, right. Oh, so after completing this chapter, you will be able to calculate the jurisdictional effective tax rate by applying the 5.1 formula, understand the jurisdictional blending, and handle special cases. So there were a lot of special cases while doing so. We will be looking at it, including loss scenarios and negative cover tax. So we will look at that. So did you understand jurisdictional blending? Can you give me an yes? What is meant by jurisdictional blending? This is a core concept of pillar, and why it is there. The rationale is very important. Okay, because the exam will test you on the rationale, not just your understanding. Why is the whole. So if you are into a role where you will be framing the pillar two policies, and you have to say, no, this is the best approach because of the reasons stated there. Don't just concentrate on calculations, because that's not what is actually tested. They will understand whether you can get into the shoes of a policymaker as a senior person in policy drafting. That's what is actually tested, guys. Okay, so in every thing you have to understand the rationale. Ask why, because that's the biggest takeaway here, and not how it is computed, right? They don't want a person who's computing, rather they want a strategist to kind of operate and plan on this. Okay, so the entire edifice of Pillar 2 rests on deceptively simple calculation, dividing adjusted cover taxes by net global income to produce an effective tax rate for each jurisdiction where MNE group up. If the rate falls below 15%, the jurisdiction is low tax and top-up tax applies. If it meets or exceeds 15%, no further action is required. Yet behind the simplicity lies a fundamental design choice that shapes the entire framework, and that is jurisdiction blending. Now, what is this? This is basically the words or your textbook of the explanation I just gave you. Okay, the OECD would have measured ETR globally, averaging all taxes against all income worldwide, or by entity, examine each subsidiary in isolation. Instead, they chose the middle path. All entities in the same country are blended together for a single jurisdictional ETR. The choice balances comprehensiveness. This is the words that should come in your answer. The choice balances comprehensiveness with administratability, allowing within country variations to offset each other while preventing high tax countries from sheltering low tax countries elsewhere. Are you understanding all these words now? Understanding ETR mechanics and the blending principle that underlies them is essential, because the outcome of this calculation determines whether tens or hundreds of millions in top-up taxes applies. Okay, so that is jurisdictional blending. Now we will go into much more like few things about the ETR formula. Now, what is the ETR formula? The ETR calculation is a pivotal step that determines whether a jurisdiction is subjected to top-up tax. Article 5.1.1 provides this formula, and you know the formula. Okay, it is ETR is adjusted cover taxes divided by jurisdictional net flow in. Okay, so basically, why once you calculate an ETR, there are few things that you have to keep in mind at the calculation stage. That is, you have to always express it as a percentage and round it to 4 decimal places. Okay, so if it is 14.9994, still there is a top-up tax. You understand? There is a 0.006%. So there will you have to round it to 4 decimal places. Okay, and if ETR is less than 15%, the jurisdiction is low tax and top-up tax applies. And if ETR is more than or than or equal to 15%, then no top-up tax for that jurisdiction. It's as simple as that. Okay. Now, I told you there is jurisdictional blending. So, what should be included in adjusted cover taxes in the numerator? You cover taxes after all adjustments from part 4, current tax adjustment, DTA tax allocations. Okay. So, you total all the adjusted cover taxes of jurisdiction after all these adjustments. Okay. And jurisdictional net globe income is sum of globe income of all constituent entities in the jurisdiction minus globe losses. So it's an aggregate. Whether if somebody has so let's say that there are two entities in UK. This one is having 10,000 profit and this one is having 50,000 minus. So what would be the net income, net jurisdictional globe income of UK? This is having, global income of 1 million, and this is having a loss of 500,000. So what would be the jurisdictional globe income of UK of this group? What is the jurisdictional income of UK? The denominator of UK. I told you we'll be calculating it jurisdiction by jurisdiction. What would be the denominator? So it would be the sum of globe income of all E's in the jurisdiction minus sum of globe losses. Okay, so there are only two. So you have to add all the positive ones minus the sum of all the negative ones. So here the globe income would be the denominator for ETR calculation in UK would be 500,000. Okay, is this clear? The ETR formula and how jurisdictional blending has to be applied. So, so a few core principles of jurisdictional blending. Globe rules use jurisdictional blending, not global blending. This is a fundamental design choice that represents how ETRs are calculated. What jurisdictional blending means is all constituent entities in the same jurisdiction are combined for ETR purposes. So jurisdictional ETR is sum of adjusted cover taxes of all CEs in the jurisdiction divided by sum of net global income of all CEs in the jurisdiction. So you have to do this to calculate the ETR of a jurisdiction. Okay. Now, why this matters is because let's take this example. Now, entity A and entity B, you see, 10 million is the globe income and 2 million is the cover taxes. So they have paid an entity wide ETR of 20%. Entity B is only having an entity wide ETR of 10%. Okay. Now, if I go for jurisdictional wise, then sorry, if I go for entity wise, then entity B now have to file GIR and pay globe taxes. That's too much. If I go for an MNE level, then there won't be any tax, considering that there are other high tax jurisdictions elsewhere. So jurisdictional blending, if you take, even if in that jurisdiction, how much taxes would we pay? That's what. So if for the globe income total 15 million that we made, did this particular person or this particular MNE pay more than 15% taxes to that jurisdiction's tax authority? That's what they will be looking at. And in this case, it has. So this is a good relief, right? So if you aggregate it, total it, you see that it is 16.67. So that means that on an average, I have paid 16.67% of taxes to that jurisdiction's tax authority. So I am kind of correctly taxed there. I am not a low tax constituent entity. Okay. So this is why there is jurisdictional blending. Now, while assessing top-up tax, do not calculate per entity. Calculate ETR per jurisdiction, and a single high taxed entity can eliminate top-up tax for the entire jurisdiction. So this is what it is. This is additional notes for you just to read. Okay. So jurisdictional blending, this is the kind of things which will increase your marks. So jurisdictional blending rule creates both planning opportunities and compliance concerns. They will ask a question whether this is justified, whether jurisdictional blending is the best way forward for top-up taxes. So so they will say evaluate. So evaluate, whenever you say a question with evaluate, it means you have to write both pros and cons. So you have to see with the jurisdictional blending on the opportunity side, a group with low taxed IP holding company in Ireland might reduce or eliminate its top tax exposure by expanding substantive operations in the same jurisdiction. The higher taxes on those substantive activities blend with low taxes on IP income, potentially raising the jurisdictional ETR above 15%. On the compliance side, groups must carefully aggregate all entities, including those might have seen immaterial individually. A small loss-making subsidiary affects the denominator, but a heavily taxed service company affects the numerator. The blending calculation only works correctly when every constituent entity is properly identified and included. So what they are saying is don't include or don't exclude anybody because of materiality, but if you take their percentage, it would kind of bring in an upper percentage in terms of ETR. Okay. So that is the thing. Now let's understand calculating jurisdictional net globe income. Now, how would you calculate the jurisdictional net globe income? You will take a sum, an aggregate of all the globe income and losses of the entities in the jurisdiction. Correct? So Article 5.1.2 defines jurisdictional globe income as sum of globe income of all Cs minus sum of globe losses of all the entities in that jurisdiction. So basically, you take a sum of the globe income of all the entities. Okay, that's how you calculate the denominator. Now, step-by-step processes identify all the constituent entities in the jurisdiction. For each CE, separately determine income, globe income or loss. You have to do all the part 3 calculations on an entity basis. And then you find out the globe income. Now, sum all positive globe income amounts, then sum all negative globe loss amounts, subtract total losses from total income. So that's how you calculate the jurisdictional net globe income, as simple as that. Now let's do an example. So let's say that AR Group has group entities in Germany. Okay, these are all in Germany. So you tell me what is the globe income of the jurisdictional or Germany jurisdiction globe income. The denominator in Germany that I would use. What would be the denominator for Germany? 56 to 80,000. Okay. So let's see. So step one, what in terms of step, what did you do? Step one, total globe income you have added 53. So whatever is the positives you add, the negatives you add, and then positive minus negative. This would be your total globe income. You can just aggregate, but this is how they have told in the law that how the formula should be. Okay, 5.1.2. So if you write it like this, then that means you have really gone through the global. Okay, so good job there. This is how you have to aggregate. Now, yeah, so this loss would decrease the loss from SG Germany, it reduces the jurisdictional denominator, which increases the ETR, obviously. So, this would reduce the denominator. So, overall, it is very good because the fraction, the ETR would be more if the denominator is reduced. Okay. Now there could be special cases. It's all like adjusted cover taxes. Add all the adjusted cover taxes divided by the sum of all the globe losses on income of the jurisdiction. Now there could be some special cases. This is pretty interesting. One thing is, what if everybody has a loss? What if the net globe loss? Okay, if the total of the jurisdiction, if you total everybody, the denominator has a net global loss. It's a negative denominator. Then what do you do? If you have a negative denominator, then no ETR calculation can be done, because if it's a negative denominator, you can't do any calculation. So jurisdiction is not subject to top up tax for the fiscal year, because it's see, if the total is a loss, then there is no need of any taxes, no. So if the denominator is negative, the jurisdictional denominator is negative, then that jurisdiction is not coming under top up tax. Okay, very key rule. Did you get it? Why? Because if it's end of the day, if it's a loss, then there is no need of a top up tax. Okay, so yeah, that is a you cannot have a meaningful tax rate when there is no net income tax. Jurisdictional net income is let's say is 500 5 million negative. No ETR calculation, no top up tax for this fiscal year. Loss may be carry forward. Okay, you can carry forward the loss and all as a DTA benefit, but the thing is, you will not get any if the denominator is negative, the total of the denominator is negative, then there is no top up taxes for you. Okay, this is scenario number one. Yeah, so there is an exception which we will learn later. So it's called the negative cover taxes loss in a year. If the adjusted cover taxes are also negative in the year and their absolute value exceeds the expected adjusted cover taxes, additional current taxes arise. Now, don't worry about this. I'll just tell you what this means. It's basically what they are meaning to say is, let's say if your cover taxes, if your denominator or aggregate globe income is negative. Okay, in our example, we took like $5 million. And if the denominator is negative, I told you there won't be any top up taxes, right? But there is an exception. The exception is if the numerator, that is aggregate adjusted cover taxes, is also negative, is also negative, is also negative. Let's say it is somewhere around 1 million. So if it is also negative, then The idea, the top up tax, what they are telling is like, this loss I will carry forward as a DT advantage. Yes or no? This 1 million I'll carry forward as a DT advantage. Yes or no? I can carry forward. So your loss also should be commensurating to your, the adjusted cover taxes is also commensurating with, no, I mean, this you will carry forward 5 million, but this is actually the tax. So that means you have got a refund or something, or like, initial credits or something. So in such a case, what they are saying is if you have an income of 5 million, so your cover taxes could could be a maximum of what? 5 million into 15%. So it should have been what would this come to? It would have been 750,000, correct? That should have been that. Now, if your adjusted cover taxes is negative 1 million, that means you are still a low tax jurisdiction. Your tax rate is way below, or you are getting a refund. So the difference, that is 1 million of negative 1 million minus this 750, negative 750,000, which is going to be 250K, you have to pay as a tax. Are you getting it? This we will learn later, the loss adjustment, but basically the logic is this. If I have a loss, then the covered taxes should also be 15% of this loss, right? If the covered taxes are negative, then this should only be 750,000. Why are you getting a covered refund of 1 million? Then that means purely there is something wrong. And what is the differential? You have to pay tax. Getting it? Okay. So this we will learn later, but as an except, it not always. If every time it is a negative denominator, I told you it is not applicable. It's not always. There is this one exception, that if the adjusted cover taxes are also negative in the same year and their absolute value exceeds the expected adjusted cover taxes. What is the expected adjusted cover taxes? Globe loss multiplied by 15% rate. Additional current top-up tax arises for that fiscal year. Now you understand this paragraph? Okay. So first case we let it was a negative globe income. In negative globe income, no top up taxes. Okay. Aggregate globe income is negative, no top up taxes, except when the cover taxes are also negative, then you have to do the loss carry forward exception. Now, second case, if it is total is zero, then what do you do? If the total globe income, aggregate of globe income in all jurisdiction is zero, then what do you do? Then also you can't do anything. Anything divided by zero, I feel, is a mathematical impossibility. So if jurisdictional net income, yeah, note, okay, if the jurisdictional net globe income is exactly zero, no ETR calculation is possible. So no top up tax applies. Okay. So if the denominator is aggregate zero, then also there can't be any. If it is negative or if it is zero, you can't do any top up tax calculation. Okay. Right. Now, what about negative adjusted cover taxes? Now, I told you when the numerator is negative, no top up taxes, except for that exception. Now, if the numerator is negative, then if the numerator is negative but the denominator is positive, then why would there be a negative adjusted cover taxes? Because you will get refunds. You get deferred tax credit exceed the deferred tax expense, or tax allocations result in net outflows. So you could get negatives, right? I mean refunds and all. So if it is negative, then you have to take that negative one as the computation. So let's take an example. So let's say negative numerator. So there is a negative 500,000 because you got refunds. We learned refunds last, how to adjust 500,000. And if the globe income was positive, the ETR is negative 5%. Yes or no? So what would be your top up tax? It would be 20%. 15 minus 5. So it would be 15 plus 5. 20 would be your thing. Okay. If it is a negative numerator, it will not exonerate you from top up taxes. On the contrary, you will have to pay more than 50% as a top up taxes. Okay. So if it is both negative, then no calculation. But of course, you have to check whether 500,000 is 15% of 2 million. Okay. This we will learn later, like the loss exception. But for the discussion now, if it's a negative cover tax, then yes, my dear friends, your top up tax is going to go above 15%. Okay. Is that clear? Don't stop when you only see negative adjusted cover taxes. Okay, so negative ETR is possible and means the jurisdiction is definitely low tax. So you have to pay top up taxes of 15%, adjusting that negative as well. Now, what about very small globing? Now, there could be instances where one of the constituent entity has very small globe income but very high taxes. For example, let's say that the globe income is 100,000 and the cover taxes are 80,000. It could happen. It could happen. How can you tell me one instance how it could happen? So let's take a jurisdiction. Okay. So we will take this jurisdiction. Okay. So let's say that they have we'll take the UK one. Okay. So UK, this and let's say the okay, do it here. So UK company one, its globe income is plus 1 million. Okay, and it has paid around 25% cover taxes, 25% taxes. So it's this is 250,000 would be the tax that it paid. Okay, UK2, what happens is it has a globe loss of, let's say that $800,000. Okay, and it has not paid any tax because it is a loss. Now, if I take the jurisdictional ETR, what would be the jurisdictional ETR? The cover taxes would be 250,000 plus 0, right? Divided by the the income would be 1 million minus 800K. So my ETR would be what? 250 divided by 200. So that means that I have paid a tax of around 125%. This could happen. This ambiguity could happen if you take it on a jurisdictional scale. So what they are saying is when globe income is small, even the modest cover taxes can produce very high ETRs. Okay. So small jurisdictions with minimal activity often have high ETRs due to fixed minimum rates or registration fees. The de minimis exclusion will add. So for this, in such cases that I just explained, we have a separate chapter on it. Okay. So that time just keep it in mind that how it is going to be. But if you see that something like this, there is some adjustment coming. Okay. Now, stateless constituent entities. Now, we discussed about stateless PEs when we are discussing about categorization. I told you statelessness means something else, and I will explain. Now, what is stateless constituent entities? How is it different from other constituent entities? A stateless constituent entity is a constituent entity that is not tax resident in any jurisdiction. Stateless CEs arise in structures involving transparent entities, hybrid arrangements, or entities whose residence is not recognized by any jurisdiction. So when it is not having any jurisdiction, then it is called a stateless entity. Now, if it is a stateless entity, then you don't blend it. you don't do any jurisdictional blending. Okay, you calculate ETR for that separately. So they are excluded from jurisdictional blending. Stateless CEs are not grouped with any jurisdiction. Separate ETR calculation. Each stateless CE, you can't group all the stateless CEs also. Okay, each stateless CE should be calculated separately, and each stateless CE has its own individual ETR. And there is no de minimis relief. We will explain this later. Stateless Cs cannot benefit from de minimis exclusions, and there would be a separate SBI. SBIE means substance based income exclusions. You learn payroll and assets, that all should be calculated individually for these assets. Okay, so stateless basically means you will not be included in jurisdictional blending. You are on your separate. Getting it? This is the relevance of categorizing an entity as a stateless entity. This is where the importance comes. Okay, you might have heard of this term. So when a group uses a transparent partnership or other hybrid structure that do not have a tax residence, each such entity requires a standalone ETR calculation. The ETR for a stateless CE follows the same formula, adjusted cover taxes divided by global income, but without the benefit of blending with other entities. This makes stateless CEs particularly exposed to top-up tax since they cannot offset their results against the higher tax entities in any jurisdiction. So okay, so whenever it says a stateless entity, then that is a liability because it could kind of bring in top. Did you understand stateless entities? What it means? Okay. Now, the complete ETR. So that's it. So the complete ETR calculation process. Okay. So we will do that summary by ourselves instead of looking from a book. So what is that we learned in this chapter? Just increase one. Yeah. Okay. So, what did we learn in this chapter? First thing is the concept of jurisdictional blending. Yes, it's all kind of like what are the pros and cons. There is a lot of theory coming in from here. Then so basically like the one thing that you have to carry home is that it's a middle way. Optimizes compliance at the same time checks tax evasion, if which could have happened if it is done on a global basis. Now, then what did we learn? Then we learned that how to calculate the jurisdictional ETR. How would you calculate jurisdictional ETR? So it would be sum of jurisdictional covered taxes divided by aggregate of global income of entities in that jurisdiction. Okay, and we found a few things like few vital points which basically are that instances. So first instance has to check is first instance to check is say negative ETR, negative global income. If it is a negative global income, then there is no ETR, no top up taxes, provided there is an exception. If the cover taxes are also negative, then you have to see whether the negative cover taxes are only 15% of the current global. Okay. Then, then, then if the globe income aggregate is zero, when it is zero, no top up tax calculation, no TUT possible, no ETR calculation possible. Now, if the adjusted cover taxes is negative, then you are going to then the TTR, then it is definitely low tax. And it would be 15% minus the rate ETR, right? Making your ETR more than, or making your top up taxes more than 15% in case if your adjusted cover taxes are negative. And let me ask you one more question which was not included. What if the adjusted cover tax is zero? Then also you are low taxed. Then it would be 15% minus 0%. Anything on the numerator, if you have zero, so you will pay 15% taxes on global income, right? Uh, I think that's the permutations, combinations which could come. And also, one thing to remember just now, just keep it in the back of your mind, is there could be jurisdictions having very large ETR due to certain entities. Then there are some adjustment rules which we will study in chapter 5.5. Okay. Then we also learned about the concept of stateless entities. These are entities in the group which does not have residential status. Hmm? In such a scenario, it is done separately. Can you tell me an example like this? We have checked, I have given you examples of a stateless entity. If you kind of go back to, oh my, so if you go back to our example, you remember this? You remember this? If it's a fully transparent entity, then it's okay. The owner will pay the top up tax. But if it is not fully transparent, it is opaque in one, it is transparent in one, in either case, then these things are, my dear friends, stateless entities. Okay, this is not a stateless entity because in its own jurisdiction it is opaque. But in this particular guy, who's opaque in owner's jurisdiction but transparent in its own jurisdiction, that means the entity where it is located, its own jurisdiction does not consider it to be a resident. In such a instance, it would be a stateless entity. Then there are stateless PEs also, which we kind of like discussed. It any kind of PE which is not. I think we have discussed types of PEs. Yeah, in this chapter we have discussed like types of PEs, whether how it could be a stateless P, but it's all there in the notes. Okay. Anyways, so then stateless P's. The thing is, what is about stateless P's? Then stateless P's does not, is not applicable to jurisdictional bending. Calculate ETR separately. Okay. So are these clear? It's a relatively less difficult in terms of conceptual knowledge, but just it's more of an explainer. Is it clear? If it's clear, let's do a question. So this is basically the steps like aggregate all C's in the jurisdiction, calculate net jurisdictional globe income if it is zero, and aggregate adjusted cover taxes. Then whether it is low tax. So you know everything. how to calculate ETR. Now let's do this question. You tell me, how much is the cover taxes? So here I don't think there is any jurisdictional blending because these are all in different jurisdiction. So you don't need to add anything. It is just this divided by this. Okay. I think there was some goof up. So it's all different jurisdiction. So you don't need to combine anything. You will divide this divided by this. Okay. So that's how you calculate jurisdictional level ETR. And if any jurisdiction is having taxes of less than 15%, then yes, it is applicable for top up tax. Okay. Now you do this one. So it has three entities in UK, and yeah, everything is UK. You tell me how much is a jurisdictional ETR? Jurisdictional ETR and jurisdictional top-up tax, please. Tell me what is the jurisdictional ETR and the top-up tax? I am really appalled that you're taking so much of time to do this. Okay. So jurisdictional ETR is 29.08 wrong. Anybody else? Yes, Milvin. Congratulations. It's 29.0761%. Great eye for detail. And top-up taxes? What is the top-up tax for the jurisdiction for UK? Absolutely. Super, Melvin. Great. Love the eye for detail. So that is how you calculate jurisdictional ETR and top-up taxes. Okay. So, yep, that's it. And tomorrow we will be doing SPIE and how to kind of bring in that. So we'll meet tomorrow. See you guys.